Hello, thank you for taking time to join me today. Thanks for checking out my video, whether you do it live or at your convenience. I appreciate it. My goal is just to bring really useful, news to real estate and mortgage professionals, news that makes us better in what we do and serving our clients, potential home buyers and homeowners as we help them achieve the American dream through home ownership and the related wealth through real estate. Now, I'm really excited about my topic today because I learned a lot. I read an exceptionally informative article from HousingWire, and it was written by Flavia, Furlan, Nunes, and he writes a lot of great articles. The title of this article is "Some Mortgage Brokers Have Grown Quickly, Now They're Under CFPB Scrutiny." And the thing I liked about this article is it had a bunch of information in it that I wasn't necessarily familiar with. I learned a ton. So let's get started. I want to get through quite a bit of stuff. I'm going to share some data points that I find really interesting. Okay, so here's the basis of the story. For the first time in CFPB's history, they're now targeting brokers. They haven't audited a broker. They haven't done an enforcement against a broker. And so what HousingWire is reporting is that they are now they've created a task force, and they're now applying scrutiny and visibility to the broker channel. And this is going to be super interesting. There's a few things that they're really focused on in these audits, which I'm going to get into. Now, here's the thing. The first audit was the first company, brokerage, to be audited received notice 60 days ago. So it's a brand new thing. And it's a brand new thing. Very interesting. Here's something interesting about this too. So one thing, the reason why the CFPB is focusing on brokers is because brokers have become really big. There are very large national brokers that rival IMBs or regional IMBs, and I'm going to share some of the statistics. So Nexa Mortgage has 2,854 sponsored loan officers. So 2,854 sponsored loan officers. Loan Factory has 1,457. Edge Home Finance has 1,144. And C2 Financial Corp has 1,075. So they have a ton of licenses hanging out their offices. Now, typical to the wholesale channel, a lot of those independent loan officer brokers, they don't do it. Not only the brokers, the loan officer, don't necessarily do a ton of business. They might do one loan a year or 5 loans a year. Not to say they don't have big producers under their roofs, but they also have a lot of part-time because there's not a lot of cost associated with a loan officer at a broker shop. But nevertheless, they're big players, so they're catching the CFPB's attention. Now, what HousingWire is speculating from the sources they checked in that the CFPB may be targeting firms with at least 250 loan officers. So it's going to be firms with 250 loan officers or more that might find themselves in the CFPB's gun sights. That could include additional brokerages like eMortgage Capital with 793 sponsored LOs, West Capital Funding with 708 sponsored LOs, Equity Smart Home Loans with 426 sponsored LOs. So there's a considerable amount of headcount in these broker shops. Now, not only have these broker shops grown in headcount and volume, by the way, Nexa Mortgage has a lot of volume. If I remember right, they got close to $3 billion 2 years ago. But not only do they do a lot of volume, but they're also starting to take market share. In 2014, the broker channel accounted for 9.8% of the business. So in 2014, just under 10%. Last year, in Q2, it was 16.9%. 16.9%. And then this year, in the second quarter of this year, broker channel accounted for 18.2%. 18.2%, 1 in 5 loans. So it's becoming a significant, channel of business. So here's some of the things that the CFPB is really looking at, and I want to preface this by saying a lot of the uncertainty around how the wholesale channel works is because the regulations are really poorly drafted. And in defense, not that I need to defend the wholesale channel or brokers, but you have a lot of really well-intentioned people who have very unclear or fuzzy lines on what they're supposed to do. And so in some ways, a lot of participants in this channel of business look forward to these audits and for some clarity from the CFPB on what's right and wrong, because they want to do what's right. So here are the things that the CFPB is going to look at, and through their examination, we're going to get guidance on. The first thing is, in the broker channel, you can either be lender paid or borrower paid, but you can't be both. And so what the CFPB is wondering is, well, what are the circumstances that make it borrower paid, and what are the circumstances that make it lender paid? And are those circumstances beneficial to the consumer, right? And so if I do a loan for the Smiths today and I do borrower paid, but I do a loan for the Jones tomorrow and I do lender paid, what made me make that choice? And did I make that choice out of the best interest of the consumer? Now, here's what happens. Typically, loan officers get paid less on borrower paid compensation. In fact, there is a really interesting quote from an LO in this article, and I just love it because this is one of the drum beats I use. The source said, hey, look, I use a borrower paid, which typically is around 50 basis points, instead of lender paid when I have to compete with an IMB. That's right. A broker chooses a lower comp model when they have to compete with an IMB. And what they say is, look, IMBs have an unfair advantage because they can take price exceptions. I don't have the option of taking a price exception. And so the only way I can compete is switching my comp to borrower paid and this charging less. And the reason why that kind of, I guess, tickles my fancy, there's not a loan officer I speak with that doesn't say one of their issues is somebody has lower rates than them. When I talk to direct-to-consumer call center loan officers, they complain about the servicer having lower rates, or if I talk to the servicer, they complain about call centers having lower rates, or if I talk to brokers, they talk about IMBs having lower rates because of these PEs, and if I talk to an IMB loan officer, they're definitely going to complain about how a broker has a lower rate. Everybody complains that somebody else has a lower rate, and by and large, we all have the same rates. We just have different expense structures, at different profit, models, at different comp models, but we all start with the same rate. And so it's really interesting. So I thought that was super interesting. So one thing I want to know is, gosh, when do you do borrower paid and when do you do lender paid? The next thing which they're really going to pay attention to, that they're very, very interested in, is, okay, you're advertising, use me as a broker because I'm going to shop your loan at 200 different lenders. They're all going to fight for your loan and you're going to get the best deal from me. But then in reality, that broker shop says 99.5% of the loans to United Wholesale Mortgage, or 95% of the loans to United Wholesale Mortgage and Quicken, or Quicken, not Quicken. But they send them all to the same place. I'm advertising that you have all this choice, but if I take my loans to the same place, is that deceptive advertising? And that's something they're going to really, really look at again too. And then third, of course, what they're going to look at is, gosh, how come you took the Smith's loan to ABC Wholesale that gave you 2 points, but you took the Jones loans to XYZ Wholesale that gave you a 0.5 point revenue? How did you pick one for the Jones and one for the Smiths? And why was the revenue and the loan officer's compensation so drastically different? And then what they're going to do is they're going to put those loans under a microscope and go, did you make this choice out of the best interest of the consumer? That's going to be really tricky, because my friends I know that are brokers, I'm not sure they're always picking the highest, compensation, outlet because it's best for the borrower. Honestly, I think what this may be tainted. I apologize, because I certainly don't mean to paint anybody with a broad brush here. But I think that historically, as a broker, you have several outlets that you can take a loan, and you take it to the one that has the highest amount of revenue that's within your borrower's threshold to pay. Meaning, and so if they can go get high comp, they go to wholesale outlet A. They get medium comp, they go to wholesale outlet B. If they have to go thin comp to compete, they go to wholesale outlet C. And that's kind of the same device they use, kind of reverse engineered as an IMB taking, PEs. It's just kind of the same thing, other than it affects their comp. So, really interesting. This article had a bunch of really fascinating stuff in here. There's a couple more things I would just caution. And by the way, I love wholesalers. I love brokers. I started in the business as a broker. I was a broker for quite a few years until that platform couldn't compete on a customer service, basis. Today, I know they can compete, and I believe there's well-intentioned people in that channel, and they want to do the right things. They've really been at, a disadvantage because there hasn't been clear guidance on what the right thing is. And so the CFPB doing these investigations, these audits, is going to clarify. And most companies that are honorable, they're going to do what's right. And doing what's right is always what's doing right for the consumer. That's always a good business choice. But getting clarity from the CFPB will be good. Now, I hear this. They go, well, gosh, let's not really worry about this because there's a new sheriff in town soon. President Trump's coming back to office, and his CFPB was much friendlier than President Biden's CFPB, which is 100% the case. But you cannot put your guard down. No way. It's true. Trump's CFPB will probably have a lot less enforcement. But the next time the other party gets into office, or the next time a different president is in office, they may put a hawk in to run the CFPB, and that hawk will do retro investigations. It won't matter that at the time the prevailing vision of the CFPB was lax. The person that's going to be a hawk in the future does not care. They will skewer us if we at all misstep. And so the best advice possible is do the right thing for the consumer. Do the reasonable thing to be compliant. Don't look for lax compliance environment to misbehave. That's it. This is a great article. Thank you, Flavia. A really good article. HousingWire just keeps slaying it. I appreciate HousingWire. I'm going to put a link to this article in my notes below. I also did a lengthy write-up on my LinkedIn. Be sure to check out my LinkedIn. I try to do my best work on LinkedIn. I do a lot of write-ups with links to the articles. With that, I hope you got something out of this. I hope you're having a great day. I look forward to seeing you again soon.